The subject of this video is Treasury note purchases in the secondary market. Before delving into that subject, I will just mention that I am continuing to sell into the current stock market rally. I use traditional valuation measures for stocks, and I'm just too old to change now. I do not have much comfort in buying much of anything at current prices in the stock market. When I reach a point where I have the level of discomfort that I currently have with stock valuations, I turn into a net seller as part of my overall risk reduction strategy. I still have a significant stock portfolio, but the overall percentage of assets held in brokerage accounts allocated to common stocks is probably now below 10%. I do not need to take stock risks, which is another consideration that I have. Back to Treasury notes. I will buy Treasury notes in the secondary market to fill in my short-term bond ladder that consists primarily of investment-grade corporate bonds and Treasury bills purchased at auction. I will own some CDs as well that I purchase in my brokerage accounts. By short term, I'm referring to maturities starting tomorrow, and I have something coming due tomorrow and throughout each week through 2026, with only a small amount of purchases so far that mature in 2027 through 2029. So I'm referring to a really short-term ladder here. Most people would define short-term as 1 to 3 years. I'm using more of a 1 to 2 year time frame. The reason for this short-term focus is my age and the current yield advantage of short-term maturities compared to going out further and length as to maturity. Age is also a very relevant consideration for me. Maybe I will be fortunate and short-term rates will start to move higher again in late 2025, which I currently view as the more probable than not scenario. I will benefit by short-term rates going higher. Earlier today, I bought a 1 Treasury note maturing on 12/31/2025 that has a 4.25% coupon in the secondary market. Interest on Treasury notes is paid semi-annually. When buying one bond, I am more often than not accepting a lower yield than if I was buying 100 bonds. The difference will not be much when trading Treasuries, which is a very liquid market. If I'm okay with the yield for just a one bond purchase, and that does not bother me of having to accept a slightly lower yield compared to a institutional buyer. The YTM at my purchase price for this note that I bought earlier today was 4.408%, which is currently better than the yield on the 1-year Treasury, which is continuing to decline some and was last quoted at about 2:40 Central Standard Time at a 4.38% yield. The YTM yield to maturity calculation includes the profit realized at maturity, which is very, very small for this purchase, and a small amount from reinvesting the coupon payments when made at the same coupon rate. Those adjustments raise the yield to maturity to 4.408% from the 4.25% coupon. I am buying 1 to 4 Treasury notes in the secondary market per week that mature in late 2025 and into the 2026 first quarter. If at about a 3 months or so, I may move that into the second quarter of 2026. I do not pay a commission for U.S. Treasury trades made in the secondary market or at auction when I make the trade in my Fidelity, Vanguard, or Schwab accounts. Today's purchase was in my Schwab account, which generally has the best price for a one bond purchase. If I had to pay a brokerage commission for these kind of purchases, I would not trade treasuries in the secondary market at all. The YTM is for that note, is better than the 1-year treasury yield, and it extends the maturity to that 1-year bill, which will be auctioned tomorrow, by about a month. I am only starting to fill up December 2025 with bond and treasury bill purchases. I currently have only 2,000 in a CD maturing that month that has a 5.2% coupon, and pays monthly interest. That CD was purchased last June. I will not buy any CD for as long as their yields are below the short-term treasury yields, which is the case now when buying through a broker. Even though I live in a state where there is no state income tax, it still makes no sense to accept a lower yield on a CD than a treasury. I will generally stop filling up a month with purchases when I hit 130,000, which I've done for several of the upcoming months. The maturity amounts really start to fall off in August of 2025, so I have a lot of work to do in filling up the latter in those fourth quarter of 2025 and into 2026.